All right, welcome. Super pumped for this episode. We've got a special guest, a friend of ours. Really well in depth in the topic we're going to get to. Bob Gauvreau. Before we get into Bob's intro, this is really about, do you know if you're really making money? And I think, Bob's going to have a really, really interesting perspective on it from an accounting perspective. It's a very interesting conversation to have. Super excited to have you on, Bob. Thanks so much for jumping on, and thanks so much for giving us your time. So welcome to this chat.
Yeah, excited to be here. It's going to be great.
Yeah, for sure. I always like to kick it off. Part of it is, here's a topic. This is what we're really talking about. It really does come down to as simple as, do you know if you're really making money? But before we get into the nitty gritty of it, you can give us a bit of an intro on yourself, your business, a little bit of your history. I'd love for everybody to know, the exciting life you live. It'd be really cool.
Well, I don't know how exciting the life is, but I can give you a background story if that's helpful. So,
Sure.
founded my firm, CPA firm in Ontario, Canada, in 2008. Started off by myself. Started doing, I think the first year we did maybe 50 personal tax returns and maybe 40 corporations that I was working with. And definitely felt the challenges of growing a small business that year. Lots of challenges, including cash flow, which was not fun, doing work and then trying to collect money afterwards. That was a lesson that I learned.
Yeah.
But since then, grew and expanded to now a team of 90 plus. We're just shy of 100.
Amazing.
Full service CPA firm. We built a law firm as well. So focusing on helping businesses with their annual tax filings, business advisory. We've got a coaching program, which we call $1 Million a Year, where a lot of small businesses come in, collaborate, mastermind, and get good advice. And then we have a full outsourced bookkeeping function in our business as well. Really, what we're trying to do is create essentially the surrounding of professional services for any small business that's looking to grow and scale.
Yeah, I love it. And, we've had previous conversations before, and I think similar to the way we structure things as well, we're trying to create, much like your firm, a very comfortable ecosystem of value-added services where maybe not everything is applicable, but should you need something, you're not running into multiple directions, and you have this, one-stop shop, so to speak, and a level of comfort with yourself and your team to be able to fill those voids, for your clients, as they continue on the journey of their businesses or whatever affairs that they're working on.
Yeah. And essentially it was created out of necessity, right? Where, especially our legal firm, where we just found that we were constantly waiting for other law firms to get back to us so that we could deliver for our clients. And so we said, well, why don't we continue to evolve out our services to add legal services? So really it was something that we needed to help support our clients. And then we just sort of absorbed it, and that evolution will continue.
I love it. That's amazing. And again, there's just this natural passion to help out a client. And like you said, you're doing the work, you've got this shared service approach with a third party firm. You're relying on someone else to kind of deliver something that is critical to a client, and you don't want to hurt the integrity of that relationship. I love how you just naturally go out and curate it yourself, right, at the end of the day, and create this natural ecosystem, which is incredible. I'm sure it's very valuable, and I think it's a very smart approach to it, to be quite honest with you.
And that's what us as entrepreneurs do, right? I'm sure everybody can relate. You've offered a product or a service almost out of necessity as we've evolved in our professional journey. So
Absolutely.
Nothing different over here.
Absolutely. That's awesome. I want to get into something that is so simple in theory, but complex in practicality. And we've talked about this in previous episodes, and we've had some amazing guests on that talked about, when is it time to incorporate and what are the processes you take to go and get incorporated. But I think, we really need to hone in on the main question. How do I approach the business structure from an accounting perspective? When do I incorporate, or should I start off as a as a solopreneur. If I'm starting out a business, obviously within the crafting space, and I have a knack for creativity, and I can develop a really cool product line that perhaps can, monetize the effort that I'm putting in. At what point or when do I decide to do something that's a little bit more tangible to my business? And what structure do I start with? If I'm a one-person shop, do I go as a solopreneur, sole proprietor, or do I just go right to it and incorporate my business? Walk me through that, that journey, if you will, right?
Yeah, absolutely. So, and there's a lot of mixed advice out there,
I can imagine.
to be honest, right? And I've heard, especially in the whole real estate market, real estate agents can now incorporate. This happened a couple of years ago. There was a lot of, misinformation out there. And I think a lot of it relates to the professional services industry as a whole are sometimes lazy and aren't necessarily business owners or entrepreneurs. They're just busy filing paperwork and sometimes miss sort of the proactive element to how we can really build the right structure for us in our business and what's the right time. So, a lot of people say, oh, well, it's when you hit $1 million in revenue. Oh, it's, $3 million is when you can leave money in your company. Honestly, the real rule is that as soon as your tax rate becomes higher than 12%, which is the corporation tax rate, that's when you should be looking at a different structure. So when you're starting out, right? Let's say you start out as a sole proprietor, a solopreneur. You're starting out, you're starting to make money in your business. The moment your tax rate goes above 12% is when you should be incorporated. Now, that's the technical, because as soon as you go over 12%, we can save you money by having a corporate structure in place. But there's a few other considerations. One for me is, if I'm going into business right now, I'm making a statement to myself that I am committed to making this a full-time thing, a full-time gig, and making it successful.
Right.
And if I'm going out on my own and I'm doing that, and I know there might be some people who are doing a side hustle, which I'll talk about that in a second.
Sure.
But if this is really your full-time commitment, you should go in and incorporate now. Yes, you might not be quite at that 12% tax level, but you will be because of your commitment to evolving this entity. And I just want to say the reason we want to do that is that when you're building this sole proprietorship and it starts making money, it starts to have value, right? Whether we can sell it or not is a different question, but it starts to have actual value. And when we say, right, we're at above that 12% tax rate, we now have this valuable asset that needs to get transferred into another entity. And it becomes a little bit complicated. Potentially valuations need to happen, transfers under rollover provisions in the Income Tax Act, having to bring in professionals like me to help do that gets a little bit complicated. So really, if you're going out on your own and your intention is to build a successful, profitable business, incorporate right at the beginning.
Right.
Now, for those people who this is a side hustle, we also need to consider if you've got a T4 income, an employment income, or a T4A, you're selling something and you're earning self-employed income, as an individual with another entity, and then you've got this side business that comes in. Consider that wherever you're at in your job, that tax rate is now the bottom tax rate. You add your sole proprietorship income on top of it. So for many of us who have a T4, your tax rate's already starting at the 25 to 30% mark. So now your tax rate for this sole proprietorship that you're starting as your side hustle, you're going to be paying 35, 40% tax. And now we can avoid that if we do set it up in a corporate entity.
Right.
Not only is this corporation, good for tax planning purposes, pretty much across the board, but it also helps protect should something happen in the entity where somebody is coming after you for money. The corporation is just another level of protection.
Sure. And I think that's what it comes down to for my experience, I would say, is the awareness of what future state could bring, not necessarily current state. And I think it's a combination of, mindset as well. I'm a strong believer that start from the perspective of the act as if you will. And so, if I'm starting out my business today and I've got this passion, I've got this drive, I'm very creative, I know what I'm doing, and I believe in what I'm trying to do, I'm going to act as if I'm already an established business, and I'm going to take the necessary steps to do so. And that may actually be incorporating my business before I even earn the first dollar of revenue, to say the least, right?
Exactly. Yeah.
In doing so, I also have to look at future state of the business, like you mentioned, which is risk mitigation. Let me prevent any other form of liability to come to me, whether it is a side hustle or if it's our primary source of income. I think being able to kind of look at and measure the risk and your risk tolerance for future state is extremely critical, and why you should be speaking with a professional like yourself to give you that much needed guidance and that awareness that people may not have at any point in the state of their business, right?
Absolutely. And what I will say is, of course, there's going to be an element of cost that comes with having a corporate entity, right? Typically, for us to do a corporate filing, we have to have financial statements. You have to do a separate filing because a corporation is an identity all to itself. It doesn't attach itself to us as individuals like a sole proprietorship does. So there is a cost, right? So you're about $3,000 a year in order to get that separate tax filing in place. We want to keep that in mind, but we're also, as small business owners, whether it's side hustle or it's on full-on entrepreneurship, making the leap, we're also very resourceful. So when we start thinking of the fact that, yes, there's extra costs that come with this, we're very quickly able to go and make sure we have the money to pay for these things.
Sure.
And, the corporate structure is probably a statement to yourself as a business owner that I'm going to succeed and I'm going to go out and find the resources I need to make this successful.
Yeah, no, it's interesting. And I love how you position that, because that is an important aspect to realize. Like it's something that most entrepreneurs, myself included, when I first started out, there's a sense of being naive in that area where, you just don't realize it until it comes to a point where you need it. And I think it's extremely critical. One area of structure and kind of wrapping this up with restructure, because I think you brought up a really good point, but one area that we don't talk about a lot, and I'm not sure if you're seeing it more and more or if you're seeing a reduction in it, is good old-fashioned partnerships. Are you seeing two people effectively invest in a corporation, or are you seeing two individual people form a partnership together? And how can that differ from a corporation with forms of liability and just risk mitigation as a whole?
Yeah, great question. And I think what I want to tie into this as well is anytime there's more than one individual involved, we need an agreement in place. And whether it's a partnership, we need a partnership agreement, a corporation, we need a shareholder agreement so that everybody is under the same understanding of how the corporation and who is responsible for what and how you get paid. Everyone's on the same page, because the moment we get into these arrangements, if we don't have that agreement and that framework in place, that's where misunderstandings and changes in behavior start to happen. So that is really number one. Talking about the different structures, it somewhat depends on how the individual's family life is, if they have other people in their family, if we can incorporate other members of their family into a business. But typically, we either have it in one of two ways. One, that there's a corporation with multiple shareholders. Right. Those shareholders might be holding companies for individuals, depending on how much money the company is intending to make. We maybe complicate the structure, but it really works for taxes down the road. Or we have a partnership in place, and the partners of that partnership are corporations. Right. So, and kind of the third option is you're two sole proprietors that get together and you're in a partnership as individuals. And in that case, you essentially take the partnership income, your interest in it, and you put it on your personal tax return. Sure. So depending on how much money the company continues to make, it goes from 0% taxes up to 58% tax. So we, again, want to look at that structure and say, does that make sense for the long term? Because if we, have a corporation that's a partnership, we can limit that to, again, that 12% income tax rate. So it kind of depends on the situation, but I would always be looking to involve corporations with the idea that we're looking to make more than enough money to cover that 12% sort of tax rate.
Yeah, love it. Makes so much sense. And again, this may be a lot in terms of overwhelming information that may be new to people, but and we're, super excited to put your link up at the end of this so that people can connect with you guys and your team to kind of get a little
For
bit more
sure.
information. But keeping in mind though that as overwhelming as this may be, there are very simple approaches to this as you're building your business and whatnot. Want to segue this into the three-letter word that everybody hates, tax. And as ugly as it may be perceived to be, I think there's a lot more unknown in the world of tax than what people do know, myself included. As a business owner, as just a regular individual earning an income. So from what I understand, I guess since the onset of COVID, I can imagine there's been a series of different credits to help business owners out, different forms of potentially reducing the tax obligation, either deferring taxes or effectively bringing in credits that can help subsidize the overall business's operations. Man, this stuff can be really overwhelming, and it's like you need to be a specialist in this area. And from my understanding, like I get hives, man, if I'm thinking about this stuff and I got to talk about it. I hate that stuff. So it's like, when you're an entrepreneur, one day the sky's blue, it's amazing, birds are chirping. Then you get into like talking taxes, you're like doom and gloom. What am I doing? How do I do this? Can we strip it back a bit and simplify it and maybe take this two-pronged approach? One, very simply, how do we prepare for tax filing? And B, are there any areas in our system today that we can take advantage of specific credits for us being business owners?
Yeah, how much time do we have?
Loaded question? Yeah, I know, right?
No,
I know.
It's all good. And if I can start it on a little bit of a different tangent, but I'll tie it all back in to answer this question, because I think this is really important, especially for businesses who are in their first year and we haven't gone through it. One of the greatest problems that I see on new businesses is we get to the end of the year and all of a sudden we've had a really great year and we owe all this money. And if our cash flow isn't good, it could wipe out all our resources.
Right.
Because, one of the things, especially in this market space, is you guys might have inventory on hand.
Sure.
And, if we have, let's say we make $50,000 this year, and at the end of the year, you've got $50,000 of inventory because you continue to reinvest in your business.
Sure.
You have tax owing on that $50,000 income. That inventory is not a deduction until we sell it. Mm-hmm. So be cautious in your first year of operations to be planning this out, and definitely put money aside. So this is the tangent I want to go on. It all starts with having access to good numbers and good information. We've actually got a concept that we call, which is really a bookkeeping concept. We call it Profit Simple. And it really involves a few things in your business. One, you have up-to-date information. You can't make good informed decisions or know and plan for your income tax liabilities or your GST, HST liabilities if you don't have your books up to date. Two, they have to be accurate, because everybody and their uncle says they can operate a QuickBooks Online. But if the expenses aren't going in the right categories or the GST, HST isn't being applied correctly, you could very quickly owe a lot of money. And if it's wrong in the system, you're getting wrong information.
Right.
And then number three is being able to interpret this information and make informed decisions. So I just want to throw that out there to say this is very important. And that's why the foundation of a good financially successful business is good bookkeeping. You need to have good bookkeeping in place. Now, to wrap this into the tax conversation, so often when we're looking at people's bookkeeping has been allocated to wrong expense accounts. As a business owner, a lot of times we have bookkeepers who say, oh, that travel expense was personal. That flight here was personal. That meal out was personal, where we lose deductibility and pay more tax because these have been put in the wrong categories. We need to have a really good system to make sure we're not missing out on these opportunities. Right. Now, when we think of taxes, one of the questions I get asked all the time is, what can I deduct, Bob, to save me some tax money? What available deductions do I have? And the answer is anything that you spend money on that has a legitimate business concept behind it, whether it's going out to a sporting event or a meal or even golfing, there is a business intent behind those things. Now, meals and entertainment, they have specific rules, 50% deductible. Can't really get around that. Golfing, it's 0% deductible. Now, there's a few ways, though, that you can still get access to tax benefits. If you've got a corporation, for example, the golf dues that you pay aren't deductible, but you don't have to pay personal tax to take the money out to pay for the golf. So it's kind of really focused on strategy.
Oh, interesting.
If we have the right corporate structure in place, that's going to be number one. You know, if we're paying more tax than 12%, have a corporation in place. And if the corporation is in place and the primary beneficiary of any of these expenses that we're paying into meals and entertainment, golf, yes, they may not be a deduction, but we're only going to lose our 12% deduction. We're not going to have to pay 50% tax on it. So really, really good. The next part is, okay, Bob, that sounds great. I can essentially deduct anything that has business in its nature. But what I want to really know is, what should I spend money on so I don't pay tax? And the answer is me. Spend it on me. But okay, maybe not just me.
90 more of you at the office.
More. But the idea is, don't spend money just for tax deduction. Right. So let's think of this for a second. We've got a 12% tax rate inside a business. If I spend $100, I'm out 100 and I save 12. So at the end of the day, I've got $12 left. But if I didn't spend that $100, I pay $12 in tax. So now I have $88 in my hand. Which one makes more sense? We don't want to spend money just to get a tax deduction. But there's strategic timing that comes into making sure we're going to get as much deduction as possible. So for you guys who are looking at buying anything capital in nature, like a vehicle for your business or new equipment or new furniture for displays or whatever that looks like, if you need to buy it in March or April, because that's when the spring is coming out and people are now back into buying season, if you have the resources to do it in December, buy it in December. You get to deduct it in 2023 versus waiting all the way to the end of 2024 when you buy it in March.
Right.
The other thing that and this is probably my favorite share, is that if you have kids who are old enough to be sweeping the floor, then you put them on payroll. And my kids are 13 and 15 and super bright kids. My daughter is a wizard on social media. My son is always available to help me do whatever I need to do with physicality. Amazing, right? I pay them $1,000 a month. I get that deduction in my business. And because that's their only income source, they pay zero tax on that. Because of their personal tax exemption. So now I'm saving all of that tax money, and I've got this account that I can either take the money out and spend it on the kids for all of their costs. I know my kids cost me a fortune.
It costs a fortune.
Right. Or I take that money back and it's in a joint account and I can do whatever I want with it. So those would be some tips on trying to keep that tax as low as possible, because I'm with you. I don't want to pay any more tax than I legally have to.
Yeah, and I appreciate that. And I think one thing you mentioned that is so critical is, people will incorrectly spend money to try to save on tax rather than just pay a little bit of tax and keep more money in hand. And so I think that differentiation is very critical. And bringing someone on like yourself and your team to help advise on that, as you mentioned earlier, bringing on a professional who knows what they're looking at and can guide, the business owner is critical. I mean, I'm all in for the whole, try to do your own accounting and to what extent do your own legal, but I think there are some times when you need to bring on an actual professional that has a direct focus on this to help guide you in areas that we may not be privy to, right? Such as that, for instance. These are certain things you brought up that I myself were not aware of. And I think that's an extremely important point that you brought up. And I'm sure many businesses that are listening to this will agree with me, right?
Yeah. And it's interesting because one of the areas where there's more risk than people think is actually setting up that corporation. right? Again, the intention of us setting up an incorporation is to have a successful business that continues to
Sure.
make as much money as we possibly can. But if that corporation is set up incorrectly at day one, to actually fix it later on becomes a really big obligation and could have negative tax implications.
Sure.
So, anything that becomes structure, legal, how the business is sort of formed, we want to make sure we get that right from day one, because it is going to cost us 10 times more to fix it than it is to just do it right. And so like our team, for example, our legal team, we do about 20 incorporations a month. And it costs $2,500 to get it set up the right way. And yes, people can go online and do it for about $700, 100%, but it's guided by a tax plan, and it's guided by the right advice to ensure the shareholders set up the right way, the share classes are set up the right way, so that you don't get yourself in trouble 2 years from now when you're making $1 million a year.
Yeah, absolutely. Like a fair point. Do it right the first time. So you don't have to pay triple for down the road, right? It's the whole measure 3 times, cut once approach, right?
Exactly. Yeah.
So no, I appreciate it. I'm going to move us to a completely different direction. So now we've started foundationally where we're structured, what we're setting up, and we figured out kind of foresight. Here's my taxes, here's how I'm planning. I brought on the right partners, and now I'm at a point where I'm actually making money. And now I got to eat. I want to pay myself. I'm a business owner. I've come possibly from the world of getting a check every 2 weeks that I never really realized what, level of effort came in from the back end to get me that check. But I had a check or a wire or pay stub, whatever it is, that got paid out every 2 weeks. And now I'm a business owner. And now my pay may not be necessarily as consistent, as specifically with the cadence of payment, and most definitely the amount. Give me your perspective on, I got to pay myself because now I got to reward myself for the effort that's going in. Salary, dividends, bonus, gift cards, Bitcoin. I don't know. Throw me whatever it is you see.
Free labor, however.
Free labor, barter system. Don't know.
Yeah.
I just need to take on this because this is like such an important thing. I mean, business owners that were not business owners before, that have taken a side hustle into primary source of income, can probably get into a position of saying, man, how do I pay myself? What do I do? How do I literally cut myself a paycheck? And am I hurting my business by doing so? Right?
Yeah. Yeah.
So walk us through this. I think I'd love your perspective on it.
Yeah, no, and it's something I love to actually talk about. So I agree. There's a lot of people out there who talk about pay yourself first before anything else. Make sure you get paid. I'm not necessarily of the same, philosophy. Partially because I come from a tax background. So the moment you pay yourself, you're paying tax. You're giving money to the government. I'd rather not. So for anybody who's got a side hustle, this is why I would actually have it in a corporation. We pay that 12% tax, and then you leave it in there.
Sure.
And the idea is, when you become a business owner and you have a corporate structure in place, whether it's a side hustle or not, but your primary business and your primary income, we want to leave as much in there as possible. And this becomes our pension fund. We no longer think about RSPs, right? Because RSPs, the moment we take money out, we're having to pay tax on it. Yes, you might get an RSP deduction, but you're going to have to pay tax on it again later. What I would rather do is leave the money inside the corporation and invest it in there.
Right.
So we're kind of getting to the point where we're bringing in enough money that, one, I'll talk about how we get it out, but two, the primary objective would be to save as much as possible inside this business structure, right? Because the moment we take it out, we have to pay tax. So there are 2 ways that we can take it out. One is putting yourself on salary. Now, a salary is different in that you get a deduction in the business. So let's say you have $100,000 of revenue, pay yourself $50,000 in salary. That $50,000 is a deduction on the business, and your taxable income is now $50,000 at 12% inside a company. You're paying tax as a salary personally at the highest marginal tax rate you have. So you go from 0 all the way up to 58%. Your income's over 200,000, you're paying 58% in personal tax. The other side is on the dividend side. So this is where essentially you take a draw from the company. There's no withholding tax. There's no CPP contributions. You pull that money out, but you don't get a deduction in the company. So if you're $100,000 in income, you take 50,000 out in dividends, you're paying 12% of 100,000. Now, with that said, that $50,000 of dividends you take out, you likely aren't paying any tax on that. There's an amount, it's a sweet spot in Canada where it's about $42,000. If you take $42,000 out as a dividend, you won't pay any personal tax. With all the marginal tax credits and personal tax exemptions that we get access to, dividend tax credit, $42,000 you pull out tax-free. Now, why is that important? Well, at $100,000, if we take that whole thing out as a salary, our tax rate's about 30%.
Right.
Versus if we're in a corporation, we take a dividend out, we keep that dividend low, we pay 12%. We're saving a pretty substantial amount of money, right?
Sure.
We're saving 18% in there. So that leaves some money in the company. We pay our tax bill, but we're getting access to this money personally, tax-free. There is not going to be a situation, especially in the up to $200,000 level, where you take money out as a dividend and you're going to pay more tax. It's always going to be lower.
Right.
Part of the reason is, as a dividend, I mentioned this, we don't pay Canada Pension Plan. Now, I haven't paid into Canada Pension Plan since I was 22. And I'm good with it because I'm building a business and I'm leaving that money in the company. It's mine. I can get access to it whenever I want. If I die, my family gets it. Where Canada Pension Plan, the rules continue to change outside of our control. We get access to it when we're maybe 67. By the time you and I get there, it might be 80, right? And that's if the government doesn't spend it all and there's nothing left. So, it's about $6,000 a year that if you take salary, you're contributing to Canada Pension Plan. And that $6,000 I would rather keep, put in my tax-free savings account and hold on to it myself. So I'm fairly opinionated when it comes to dividend salary that everybody should be dividend because I don't want to give the government an extra cent, but to each their own, right? If you want to contribute to CPP, totally fine. The other piece with a dividend is when we pull out dividend money, we don't earn RSP contribution room, whereas salary we do. So if you are dead set on making RSP contributions because you feel like that's the best thing to do, you need to continue to be on salary because that's earned income that gives you that option.
Right.
Now, talk to me a little bit and I'll convince you that we don't make RSPs anymore. We leave it all in the company because we don't pay any personal tax if we leave the money in there. And that's the best way, the most tax efficient way to do it.
Right. Right. That was super loaded with value. I'm sure everyone that's listening to this is either probably considering changing the way they are paying themselves or answer the question that they may have asked to determine how to pay themselves. But I think, one thing to consider is, I want to take one step back, actually. So you made a mention of, the 12% tax bracket. I want to clarify things for people that may not be aware of it. How much do you have to earn in income to still stay at 12%? What's the maximum you're there before you tip over to the next bracket in corporate tax?
Yep. So unlike personal it's marginal, right? As we continue to go up, we go from 0 to 15 to 23 to 34 to all the way up to 58%. So once we're making $200,000 in income as a sole proprietor or any sort of personal income, our tax rate's 58% for everything above it.
Sure.
As a corporation, and we're talking net income, not sales, like after expenses, this is what our net income is. We go from 0 to 500,000. So 500,000 net is still at that 12% level. If we go above that 500 net, which hopefully we will, we still pay 12% at the bottom 500, and then it goes up to 26% tax rate inside the corporation. Now,
above the 500,000.
Above the 500,000. Now, what happens here? You might go, well, that sucks. Our tax rate goes up. But when we're paying business taxes at that rate, what actually happens is there's a pool. It's called the graduated rate income pool. And when we earn money and we're paying taxes at that 26%, When we pull money out personally, we get a reduced tax rate. And it's not perfect, right? Because we're thinking there's an extra 14% tax in that level. It's, let's say, 14% less when we take it out personally, when the company is paying that sort of upfront higher tax.
Sure,
So
sure.
the idea is that we're not paying any extra tax. The tax rate in the business goes up, but the tax rate personally drops.
Right. So you're paying it one way or another. It's just whether it's to the business or whether it's personally, depending on the
Correct.
structure and who's involved and the agreements between it, may be beneficial one way or the other. But ultimately,
Yeah,
there's a savings, but you're paying it in another direction.
absolutely.
Okay, so on that note, the business goes back to making $100,000 net income after all expenses are paid, and I've got effectively two choices to make. I can pay 12% corporate tax on it, which will yield us $12,000 in corporate tax that we've got to pay. And then I'm left with the $88,000 that I can then effectively pull out as a dividend because it's post-tax. And
Yep.
then, someone in your service can help us figure out, what is chopped up as tax-free or where the rest of the money has to go if required to. Or alternatively, I can pay myself $50,000 that I'm going to be taxed at whatever the $50,000 tax bracket is. And then the balance of the 50,000 will be taxed at 12%. And then I'll have less remaining to pull out as a dividend. So just want to kind of intuitively, illustrate the two different examples to kind of give people, what that would result in should you take those two different paths. I believe I heard you say you're more down the path of going down the dividend route just because there's so many other benefits, especially because the fact that, you're not heavily contributing to CPP. You may not be as aggressive on the RSP side. And because there's, a better strategic outlook with your money, knowing that you can use it and you have access to it much quicker with less obstacles, right? So I think that's a very valid
Absolutely.
point. And listen, I'm a business owner that wishes nothing but success for other business owners. And so, when someone says to me, I'm starting my big business, what kind of advice do you have? Or, what do you recommend? And I always say, make a lot of money first, figure out the tax portion after. But I also think that there is a lot of truth and importance to figure out your tax portion first as to what you want to do so that when you do make a lot of money, you're already set knowing how you can take advantage of what the system provides you access to, right?
Yeah, and I would say, and I agree, right? If you don't make money, you don't have any tax problems, right? But I would say, there's maybe two sorts of questions that you need to ask yourself early on, and the rest can wait until you have the earnings, right? And then we can come up
Sure.
with a great tax plan on how you accumulate this massive wealth and you minimize your tax, and that's great. But you have to have the income side there first. The two questions that everybody needs to ask is, one, what is the best structure for me? Again, likely it's going to be an incorporation for a multitude of reasons. But if we focus just on tax, when your personal income tax rate goes above 12%, you should be incorporated. End of story. And the second would be, now that I'm incorporated, how do I take money out? And in the short term, the best cash flow solution for you in your business is going to be taking the dividend, because there's no monthly source deduction requirement on a dividend distribution. So you're saving all of that cash and then reinvesting it back in your business, and you claim your dividend at the end of the year. So you don't have to pay anything to the government up front. So that's going to give you the greatest amount of cash flow in the short amount of period and maximize your tax efficiency. So those would be the two considerations I would say are a given for everybody who's in that sort of first track of your business. And then once you're making it, then we can come up with more advanced strategies on how to help you.
Oh, that's amazing. That's great. And Bob, I appreciate that because it's such a critical area. Like, I mean, you're starting a business to effectively make money. You want to pay yourself and contribute to a particular lifestyle that you want to have. And so you got to figure out how to yield the most out of it, right?
Absolutely.
I want to wrap up with two things. Number one, we're getting into the time of the year where we're getting closer to tax filing season. It's the end of the calendar year. Assuming your year end is calendar year end and you're ready to file, specifically on personal, you have no choice. It is year end. What are some of the things that we can start doing now as we approach the last quarter of the calendar year? How do we prep ourselves? Is there anything that we should be looking into before we get into filing period? Is there something that we should be potentially looking for to help us for this last stretch of the year? Guide us on what the last 10 yards looks like and before we file, right?
For sure. So at this point in the year, if we're calculating our income to be more than 12% in a tax rate as we continue to earn, right? Now is the best time to incorporate. It's not going to be next year in January. If you stop it now, you can essentially say, okay, I was going to make $100,000 this year, but I'm stopping it at 75 because I've now got a corporation. It's going to pay tax the following year on the rest of that income.
Right.
If I do that, it keeps my marginal tax rate lower. So that's for sure a consideration. If we're in a sole proprietorship sort of situation or it's a side hustle, the number one thing we're going to be able to deduct this year is going to be an RSP contribution, right? We talked about let's not spend any money just to get a tax deduction, but RSPs are definitely one of those ways that you get to continue to own the investment. It just gets you a nice little tax deduction along the way. So that is, definitely if you've got other income and you want to bring that taxable income down, any sort of RSP contribution is going to be helpful. And then I would say the other component is, be strategic with your timing. If we can push items into 2023 that we were likely going to invest in 2024, maybe early on, then we can buy that in 2023. That doesn't count inventory, right? And I do want to be clear on that. The more inventory we invest in right now, it just means our inventory is higher. It doesn't mean our purchases or our cost of goods sold are higher. It just means our inventory is higher. We don't get to deduct that. But equipment, furniture, fixtures, vehicles, anything that's capital in nature, meaning that we're going to buy it, hold it, and use it to make money, that is going to be available for us to get access to that deduction before the end of the year. So be strategic in that. Get your kids on payroll. Make sure that they're maybe getting a bonus for $10,000 this year. Again, I've got 2 kids. That's 10 times 2, $20,000 deduction saves me all my tax on that. So those would be a few considerations I think everybody should be thinking of.
For sure. For sure. Amazing. Lastly, systems, tools. Is it silly to say you're a supporter of, hey, it's your first year, TurboTax it, go into QuickBooks Online, try to figure it out, break first, fix it later? What do you approach? Is there something specific that you think we should start doing if it's our first year in business, or if we've been in business for a number of years, but we've been doing the same thing since our first year? What do you recommend from a systemic perspective to help us plan and prepare for whether it's filing at the end of the year or just month to month, bookkeeping and preparation of our financials?
I am a huge advocate for QuickBooks Online.
Okay.
It's the most elaborate system and the price point is not expensive.
Right.
It is essentially a foundation to making sure that your finances are tracked and in order. I think it's a must. If you have the time and the knowledge without frustration to do it on your own while you're getting started, absolutely. Right. It's just a tool that needs to happen and you can learn it. It also should be one of the first things that you outsource once you become too busy, because it's a fairly administrative function and you won't keep up on it because you'd rather sell something than process it in a QuickBooks Online. So for sure, as you start, that is a huge tool. I will say with the TurboTax, and of course you're going to say, well, Bob, you make money filing taxes. And I do, but I also make a lot of money filing taxes that people have filed TurboTax, or they've gone to, a discount tax preparation service that they've got 24 hours of training where we've got, on average 10 years experience and about 8 years in education. It's not a 24-hour cookie cutter sort of situation. The reason we have that education is because it's complicated.
Yeah.
And I would say, if at any point you're starting to deal with numbers where it doesn't make sense, you need to involve somebody who can help sort that out for you. If everything's making sense and the numbers are really low, okay, if you want to do your own filing and maybe that's a skill set that you have, if you have that, great, go ahead and do it. But once things start to get a little bit more complicated, your volume starts going up, you need to bring in the professionals, because I guarantee you I can save you more money than what I charge you.
Hey, listen, you're preaching to the choir. I'm the first person that puts hand up when it's, you made a comment saying, seek professional advice or guidance when you're too busy. My logic is if you don't know it, don't attempt it. Just get the right people in at the right time. Going back to the concept of, measure twice, cut once. It is absolutely the same concept. Don't do something that you feel you can inherit a major problem that costs you more to fix after the fact, right? So it's awesome. Excuse me, Bob, I really, really appreciate it. This is amazing. This is like an extremely important topic to discuss. We touched up on a lot of really cool points here. I think is absolutely beneficial to anybody listening, whether you are a business owner, you're about to start a business, someone that has a business. Again, we're going to be linking you up with all of Bob's company contact information, where you can reach him and his team. I think, he comes with an amazing perspective on such a number of areas of the business, whether it's accounting, legal, tax planning, et cetera, that I think anybody should really consider, regardless of the business size, I should say. Definitely something that you should start thinking of today and have that foresight thinking right away, and just support the mindset, support the brand. But really appreciate it. Thank you so much for joining us. Can't thank you enough. Wish you all the best when I presume you're getting into really busy end of year tax filing for within your company. But couldn't thank you enough, buddy. I really appreciate it.
No, my pleasure to be here.
All right. Take care.